Hello, everyone, and welcome to Fundamentals. Let me take you back to March 2020. Being the global pharmacy to the world, India had a lot to deliver, and it did successfully. The expectations soared, but so did the magnitude of the headwinds. While India is perceived to be the pharma powerhouse, representation of pharma and healthcare in the BSE 500 index is much lower than expected. To understand this and much more on the healthcare sector, I am pleased to be joined in by Mr. Chirag Dabli. Chirag is the Vice President Equities at DSP Mutual Fund and is the fund manager for DSP Healthcare Fund. With over 20 years of experience and a chartered accountant by qualification, he is a veteran as far as this sector is concerned. Thank you, Chirag, for joining in and giving us time today.
Pleasure is all mine. Thank you for having me here.
Chirag, my first question to you is on the sector funds themselves. The common perception is that the sectoral funds have long gestation periods and the short to medium term returns can get volatile because of the concentration in holdings the portfolio typically entails. While we understand that healthcare is a dark horse in the given times, how would you position this fund to a common investor and who would your typical investor in this fund be?
I think given that this is a sectoral fund, it will go through its cycle. Expecting a sectoral fund to outperform each year, the broader markets every year is probably not a right expectation. The way healthcare is slightly different than the other thematics or sectoral funds is that a large part of the business is probably not very cyclical per se. And the other important point is that it is also a fairly heterogeneous sector versus, let's say, any other sector where a lot of homogeneity exists within the sector. So healthcare is not as homogeneous as the other sectors, and it is also not as cyclical as the other sectors as far as the business is concerned. But equity markets, they go through their own cycles, right? I mean, sometimes healthcare will not be in preference, sometimes healthcare will be in preference, etc. If all of us have finite amount of capital and we are trying to allocate within that the best opportunities. So capital markets or stock markets, we go through their cycles of preferences within the sector, and that is what causes these bouts of underperformance, outperformance, etc. But when you think about healthcare as a sector, you look at the last 20 years, returns are very similar to the broader healthcare index as a whole has returns which are very similar to the equity markets, but it goes through an annual or 3-4 years of underperformance, then outperformance, and so on and so forth. So I would urge investors to have at least a 5-year view on the sector, given that it's a sectoral fund, and not expect it to outperform the broader benchmark every year. So my typical investor who would want to come in the fund is somebody who has long-term capital, who's looking to invest, and generate long-term capital return, but not necessarily outperform the market every year.
Right. I think, that is a right way to set the expectations. And alluding to your answer, you rightly mentioned that, it is a very heterogeneous group of companies that form a part of a healthcare fund. And I would like to begin, by picking up on pharma companies themselves, largely because you have a very high active share in the fund. Now, for the benefit of our investors, could you explain and break down the various moving parts in terms of API, CDMOs, export formulations, Indian formulations, etc.? And what would be the rationale behind having such a high active share in the fund as well?
So like I mentioned, it's a fairly heterogeneous sector and multiple subsectors that form everything together as healthcare. While in a retail investor's mind, typically when you think of healthcare, you think of the large cap names, right? The broad top 4-5 names, and it becomes very generic heavy per se, right? Generic business heavy. This is where India excels as a country, which is largely the generic business. Both the India business as well as the export formulations business are both generic largely for the Indian players. The reason to have all these multiple businesses across multiple subsegments is to diversify away from the generic business. The heavy index contribution towards the generic business is very heavy, and the idea is to diversify away from the generic business to create a more holistic, wholesome, diversified business portfolio. Now when you think of the various sub-segments, right, whether it is India formulations or export formulations, APIs, CDMO, hospitals, pathology, all of these are the multiple sub-segments within healthcare. Each of these businesses have very different drivers, and it is very unlikely that all of them will do badly or all of them will do well at the same point in time. And which is why I always say that the idea is to create a diversified portfolio across these multiple businesses so that you tend to benefit as well as not lose too much on the downside. That's the idea behind creating this diversified portfolio. Active weight, I think the important piece here is to see we are very, very bottom up in our stock picking, right? We don't necessarily because we like some particular thing, we'll just go out and buy everything. That's not how it works. We do a very, very bottom up kind of analysis, and what you see as a portfolio or as a macro number is all a derivative of the bottom up stock picking that we kind of do. So while we keep the macro themes in mind, large part of the portfolio construction is basically a very bottom up kind of approach. So to that extent, I think the active share is a result of the bottom up analysis that we do. So for example, my top 2 holdings in the fund are actually exactly almost equal weight as far as the benchmark is concerned, right? And we may, somebody might say that you are hugging the benchmark on your top 2 holdings as far as the fund is concerned. But the point there is that I like those businesses at those prices, and hence I own them. And in some sense, I can't own more of these names. So while it is a maxed out as far as the benchmark weight is concerned, I can't own more of these. It's a mix of those kind of issues that you see when you just look at the active share.
Right, Chirag. Now, the most important concern as far as owning pharma companies is on the regulation bit, because the FDA regulations can come really strong, be it in terms of monetization, which includes large penalties, or also long suspension of operations. How do you view the same? And how do you go about stock selection considering this important constraint in mind?
Look, I think FDA risk is a risk that is an unknown, and we don't know, who will go through a bad FDA inspection. Over the last decade or so, we've seen all sorts of companies go through FDA issues, right? The best of the companies have gone through bad FDA inspections. It's not something which is it's not something that you can really manage as a risk. What you can do is react to stock prices, because stock prices will react to developments around the FDA. What we've seen is, by and large, at least for, I can safely say that for us, we've actually seen more opportunity being thrown because the markets tend to be very volatile when there are FDA actions, and we've seen this more as an opportunity for an active investor. For a professional active investor, there is more opportunity in the FDA volatility rather than a threat per se. So that's the first point. The second point is that, is this sector really investable? Is a lot of times I get this question, that is this sector really investable given the quantum of FDA risk that we see? And I have only 2 data points to be for that. One is that India as a whole, as a country, Our participated market share, largely in the oral solids market, is about 50% by volume. So we are not small, right? We are very, very large. Uh, and we've over the years, through the challenges, and we've always had extreme examples on both sides, right? Very bad companies went through very bad inspections, and good companies that went through good as well as bad inspections. We've had both those examples. But through all of this, India as a country, our participated market share is 50%. So we're not small. I think we've come a long way as far as FDA rules and regulations are concerned. I think by and large, as a country, we've delivered on that quality promise that the FDA wants you to, deliver on. So for me, I think FDA risk does not mean that I don't invest in the sector. And by and large, as a professional active investor, it has thrown more opportunities for us rather than threats.
Right. Now, coming to the next piece as far as healthcare is concerned, which is the hospitals. Now, if you look at while we all talk about the demographic dividend India has to offer, but we also forget that, 30 crore Indians are above the age of 50. There is an aging population worldwide who do not have access to immediate healthcare needs, and that is the reason the medical tourism in India is also always on the rise. Situation where we do not have enough hospitals and medical professionals to take care of the people who actually need medical, assistance. Hospitals have huge entry barriers, and probably that is the reason why a lot of hospitals are kind of taking the route of mergers and acquisitions to spread in different geographies and locations. However, when I look at the portfolio that you have to offer, we don't see too much of exposure as far as direct hospitals are concerned. I would like to understand from you whether valuations is the reason behind this, or my observation, what I pointed out, there's something that I'm missing.
Sure. So, hospitals are fairly local business, very fragmented business. All India market for hospitals is in the ballpark of about 70 to 80 billion dollars. And our largest hospital company will probably be having revenues of $1 billion. So that's how fragmented, this industry is. We have to look for, 5-6 years back, we had only a couple of hospitals as investable opportunities. Over the years, now more IPOs have come. Now I have a chance of owning, at least 10-12 hospitals are there in the investable universe. At peak, we used to have a fairly large, exposure to hospitals. Over time, we've been, booking profits through. There are two things that we see as, as concerns. One you rightly put out as valuations. Hospitals are valuations are a little bit punchy versus their own history. And I want to kind of differentiate between two hospitals probably trading at similar multiples. One hospital which is trading, which has a 75% occupancy, and another one that has a 60% occupancy. I'd probably prefer the one at 60% occupancy, because there the margins are not peakish, right? The other one at 75% occupancy is probably trading, has very high margins, is probably closer to its peak potential as far as earnings are concerned. So that's how we kind of differentiate between two hospitals. I'd probably look for somebody which is, much lower occupancy, because there is that scope of extra earnings delta. So that's how we're thinking about it. We want to avoid peak earning, peak multiple. This is something that I've extensively talked about in my framework as well, that peak earnings, peak multiples is something that we not do across the board. So in that sense, some of these names are trading in those kind of zones, and which is why we've kind of, over the years, over the last few months, booked profits out of these hospitals. As a space, as a business, we like the hospitals business. There's a massive, like you pointed out in your initial comment, there's a massive opportunity here for quality beds in India, and with increasing medical insurance penetration, we are seeing a lot of demand for high quality beds coming through. Uh, and that macro picture is very clear, but I think it's the bottom up that we are kind of a little worried around.
Understood, Chirag. Chirag, my next question is about the differentiating part of your portfolio construct. So when we look at your portfolio versus peer group, we see that you have a significant exposure, more than 10%, to US healthcare companies, names like Globus, Intuitive Surgicals, Abbott. These are some of the names which are not there in any other portfolio. So if you could help us, A, understand what is the rationale of investing into these companies, and B, what is the kind of correlation these companies have vis-a-vis BSC Healthcare Index?
So first, to your last point, right? These are businesses that conceptually have a very low correlation with the BSc Healthcare Index, right? And BSc Healthcare Index, like I said, is a very generic heavy, index per se. So correlations will be less than, 0.24, less than 0.3, so idea is to add a little more diversification versus a typical generic business. So that's the first point. But more importantly, I think it gives us ability to invest in some very high quality next generation technology. If you look at the list of companies that we own in the international arena, these are companies that are doing stuff which is the next generation technology, right? Something where we see a lot of scope to improve penetration. So for example, robotic surgery penetration globally today is 2%, right? And looking like going up. And we talk to our own hospitals, in India, they talk about increasing the number of robotic surgeries that they will do. So you see an opportunity to grow even in a market like India, and obviously in developed world. These businesses, we don't have exposure, we don't have an opportunity to invest in India at all. The other bucket that the international exposure belongs to is in genomic research, where again, this is the next frontier of technology, that is happening within the healthcare space. And gene technology is something which is, viewed to eventually, cure a lot of diseases which today we think are not curable. And let me just give you a couple of use case examples for something like genomic, and that just gives you a sense of how to associate with these companies. A while back we used to hear a lot of women die out of breast cancer, right? Today we don't hear a lot of people, women dying out of breast cancer. In fact, social media will be full of it will be full of cancer survivors or testimonies from cancer survivors. So what has changed really? It's not that there has been a new medicine for cancer, right? It's just that the gene mutation which is caused which causes breast cancer and has been isolated, and more women are now testing themselves and hence catching cancer early in stage 1. When you catch cancer at stage 1 versus stage 4, the odds of treatment just go up 70 to 100 times. So that kind of change is already happening, and we want to participate in these businesses, and that's why we want to kind of we own some of these names. So what the international piece does is that it gives us ability to invest in such businesses which are today not possible for us to invest in India. The other thing that the international business does, exposure does, is that it gives us an ability to invest in industries that we like, where there could be a few options in India, but those assets, because of the scarcity premium, are getting priced up big time, right? And we don't want to probably participate at those kind of high valuations in those names. We probably will invest in relatively better managed companies globally in the same industry, but which are not trading at those kind of multiples, because globally there isn't a scarcity premium that stock markets are attaching to these businesses. So it helps us both ways, continuing to own businesses which are just not possible to own otherwise in India, and also while in some industries where there may be options to invest in India, but those stocks may be very, very expensive, compared to their true potential.
Understood. So Chirag, my next question is about something which was a darling of market during COVID times, and that's diagnostics. And at that point of time, everyone was extremely bullish on diagnostic. However, we have seen the sector facing a lot of headwinds in the last 2 years. Now, when we look at your portfolio, you seem to prefer radiology over pathology. Some of the names which are very popular in many portfolios don't even feature in your portfolio as far as diagnostics is concerned. So what's the view and rationale on that?
So look, as far as pathology is concerned, everybody and his uncle wants to start a pathology lab, right? Today we are seeing pharma companies, we are seeing online, medicines companies, we are seeing private equity backed competition come through. At the margin, that intensity may be coming down, but there continues to remain zero entry barrier as far as this business is concerned. Return on capital on these businesses, upwards of 40-50%, which means that capital comes back to you. Payback periods can be 2-3 years, and it still remains a very attractive business for a new entrant to come through. So we are a little worried around pricing and about disruption in this industry as far as pathology is concerned. The reason to prefer radiology is that radiology is a capital intensive business far more than the pathology business, because you can't, you can order a blood test online. You can't order an MRI online. If you have to do an MRI, you have to walk into a center. And if I have to walk into a center to do an MRI or a CT scan, etc., I will rather go to a much well-run, a good, center. So, which is why we prefer the radiology or a hybrid business where radiology and pathology are, part of the same center, versus say pure pathology, which I think is a little more disruptible, at least on the pricing front. So that's the thought, that radiology is far less disruptible, needs far more capital. Also, the other ancillary point is that I see standalone pathology companies incrementally investing or doing M&A at expensive valuations. When you pay something 24-25 times EV/EBITDA, incrementally that return on capital on that investment that you've already made could be in low single digit in terms of ROCE. I think a better way to grow is to actually use that capital and probably grow in radiology rather than do an M&A in expensive M&A in pathology. So in that sense, I think we are preferring these hybrid companies rather than standalone pathology.
Understood. And Chirag, I'll go back to one of the answers which you gave, and where you mentioned that insurance penetration is increasing in India. And my question is specific to that. Now, if you look at present, general insurance penetration, stroke, health insurance penetration in India is at a lower level, and people have learned that during COVID time, it is something which they should have. It is becoming a part of the essentials going forward. But when we look at your portfolio, you just have exposure to only one company in that segment. So what is the reason for that?
That's the only choice I have, Harsh. I think so. There are two companies in health insurance that we can own. Our view there is that we are probably preferring the multi-line guys versus the standalone health insurance guys. That is the view, and that is the reason to own only a multi-line health insurance. You can argue that it is not health insurance, it is not pure play health insurance, which is a fair point. About a third of the overall business is health insurance, while the other is other parts of general insurance. But we are preferring the more multi-line guys rather than standalone health insurance people. So that's how the business construct is, and I think again. There aren't enough choices really. I don't want to buy life insurance because large part of life insurance is really just investments, right? They're selling investment products and not really, life insurance, etc. So we want to stay true to label when we tell you that we are a healthcare fund. We want to be true to label, and we want to make sure that we are indeed a healthcare and related fund, rather than so we stick to this asset allocation as far as the general insurance piece is concerned.
This, Chirag, we come to the last part of our discussion, and this is more about investor who's looking to participate in this sector. Now, if we look at YTD return, healthcare index is given around 20% return, though I don't want to have a short-term approach in this, but still to understand whether at these levels, when healthcare index is almost at lifetime high, does it still make sense for investor to participate? If yes, should it be staggered approach or a lump sum approach? And what should be the ideal time horizon? Though you mentioned at the beginning of the conversation that you would look at an investor looking at this category for 5-6 years, but at these levels when money is entering, does the investable period extend or it still remains the same?
Look, I think 5 years view has to be there. That is very, very clear. As far as tactical investment lump sum versus SIP is concerned, I think SIP is a no-brainer, more so in healthcare as a sector. We looked at the last 20-year data, and we looked at 5-year rolling return, and we've seen that over the last 20 years, double-digit return has been 90% of the cases. More than 10% return for the basic healthcare index has been for 90% of the time. So for as far as SIP is concerned, this is a very good product. That is a very clear thing. On tactical, the reason why we like the sector today is that valuations today are in your favor versus history. Probably the healthcare as a whole, right, hospitals and pharma put together, today trades at about 10% kind of a discount to the Nifty. Historically, we've traded at between 20 and 30% kind of a premium. Now, I don't know which way this, how this gap narrows, whether the market falls or healthcare does well. But I think that this gap will narrow. I think last 2 years return has not been great for the healthcare as a sector, probably in single digit kind of a number. So to that extent, I think there is still some room. The cyclical part of the business, which is the US generic business, is going through some, it went through a bad phase over the last 2 years, and that is changing at the margin. So we think that, timing today is not a bad, today the time for a lump sum investment is not bad. And for SIP, it is always a great time as far as this product is concerned.
Great. And you're one of the few fund managers who at these levels of market is having conviction for investor to go lump sum. And that's really good because we don't have many opportunities where we can participate in big way at these levels.
I hope we are right.
No, since it's the end of our discussion, and thank you so much for taking us through different aspects of not just healthcare, but sectoral fund dynamics, about heterogeneity of this sector, the return expectation, and also very interestingly, you discussed about tech in healthcare, which was something which most of us were not aware about, and how the structure of diagnostics over a period of time has changed and how it is looking to change in the near future. And last but not the least, your comments on valuations and how it stands at this point of time is going to help our investors make an opinion about whether they want to participate in this or not. Thank you so much for taking out time on a busy day and helping our investors understand the finer nuances of healthcare. Thanks a lot. Really appreciate.
Thank you for having me. Thank you.